Welcome to Bloomberg ETF IQ. I'm Katie Greifeld.
And I'm Matt Miller. We have a big week ahead of us.
Big week. It starts tomorrow with CPI and then that all-important Fed decision. I can't wait.
I'm really looking forward to it as well. Let's get to the biggest stories in the more than $10 trillion ETF industry globally. A big week for central banks. The Fed and the ECB are the highlights of major monetary policy decisions. Will it be a pause or a skip or maybe even a hike?
We're going to find out soon. But in the meantime, bonds are back. Fixed income ETFs bring in billions. We're going to be speaking to the co-head of iShares fixed income ETFs in just a moment.
And after last week's air quality turmoil, we'll look at one ETF that tracks companies engaged in recovering from natural disasters.
And Matt, as always, Eric Balchunas from Bloomberg Intelligence is with us now looking at the flows. Eric, what do you got?
Katie, Matt, thank you very much. If you are bullish, I've got good news for you again. In fact, really good news. Look at the one-week flow, $24 billion. That's almost all equities, right? IWM, small caps having a huge couple of weeks here, $3.4 billion. That's a ton, even for IWM. USCL, that's an ESG fund that somebody pulled money out of another one, so I'm not going to count that. And then you look on the list, SPY, EFA, VU, RSP, Equal Weighted, Qs. You got to go down to number 14 to find a bond fund. When's the last time that's happened, right? So this is very good. We've seen all year equities up, but no flows. Now the flows are here. Let's look at the outflows. There aren't many. And when you look through here, it's a lot of bonds and energy. Money coming out of both of those areas. Sussel, that's the ESG one that the pension fund from Europe pulled out of to go into the other one. So again, doesn't really count. But again, out of gold too, that's arguably a good sign. So let's look at where we stand in what we've been calling the FOMO drought all year. That's basically the gap between fixed income ETF flows and equity ETF flows. Normally, equities demolish fixed income ETFs, but this year, the gap was negative $23 billion at one point because people were just not buying this rally, but they started slowly coming back in, and it's almost now equities passing fixed income. This is when we're going to declare the drought over. The one caveat, though, is half of this is international ETFs. So, Katie, Matt, it's all good news, but you'd like to see U.S. equities still get a little more to feel completely bullish and like things are back to normal.
Yeah, I think the AAII just turned bullish for retail investors. So maybe FOMO is coming back. Eric, joining our conversation right now, Steve Laipply, global co-head of iShares fixed income ETFs at BlackRock. And Steve, you're in a great position in order to judge what investors think about this rally that we're seeing, even though you're focused on fixed income. What do you think investors are looking for right now? Safety, or are they getting greedy?
Oh, I think investors are being somewhat cautious. We've seen most of our flows this year go into very high quality exposures. So last year we took in over $100 billion in the U.S. Most of that went to treasuries. That's playing out the same way this year. We've taken in around over $40 billion this year, and 30 of that has gone into treasuries. Something that might surprise the audience is that a third of that has actually gone into our longest duration treasury, TLT. So investors do appear to be moving out somewhat in duration, and I think that is basically a function of two things. Number one, yields are attractive for the first time in quite some time, but secondly is somewhat of a hedge maybe, because we're still going to see quite a bit of volatility as we get this data in, as we try to understand what the Fed's doing. So I do think investors are seeking some ballast in their portfolios, even though equity sentiment does appear to be turning more positive.
And Steve, just to put some numbers on that, on those TLT figures, it's pretty outstanding. I see TLT, according to Bloomberg data, taking in $10.7 billion so far this year. Then you think about what it saw last year, $15.7 billion going into TLT. Where is this money coming from? Are these new investors to the ETF landscape maybe taking this money out of mutual funds? Or where do you think this demand in terms of the billions of dollars, the record flows that we're seeing into this product actually coming from?
I do think it's a combination of investors. So we do see a lot of model-driven flows into TLT and the other maturity cuts, but we also see quite a bit of institutional money now trafficking in TLT. So the options market on TLT has heated up quite a lot in the last couple of months. We've seen some really interesting trades go through the market, and those are institutional investors and potentially even traditional fixed income players that are starting to recognize the utility of those products and the options on them.
So, Steve, that's a great segue. We're going to ask you about HYG. The options on HYG are I've been tracking this for years. This is a chart that just goes up and up and up. What's your take on this, that options on HYG are sort of replacing or the new CDX? This is the way to hedge yourself from a credit event. Do you see that, HYG stealing market share from CDX?
We do see that. We hear it. We hear that from both clients and broker-dealers that in terms of just a overall portfolio hedge, I mean, if you step back and think about what an option on HYG or LQD or TLT actually is, it's an option on a bond portfolio. So if you are managing risk in your bond portfolio, that's about as close as you can get to the risk that you want to hedge. So it makes sense that these products have become a lot more popular relative to just a pure spread option, which is what CDX options do. So we're seeing increasing interest from credit players and, as I mentioned before, even institutional rates players in these options markets.
One other ETF of yours that we track a lot is IUSB. This is the Universal Bond Index. And to me, this is a better version of the AG. It's got a little dose of high yield international. This is what bond managers do to beat the AG easily. This one has it in. Bond managers' beat rate goes down. I think it's going to be bigger than AGG someday. What do you say?
We have seen very good flows into IUSB this year. I think we've seen about 4 billion. AGG's taken in about 7. So it's keeping right up. AGG is a monster fund. It's 90 billion. However, IUSB is over 20 billion now. So it is growing very rapidly. I do think, Eric, a lot of investors share that view that it is a good total bond market exposure. It includes not only the ag components, but also EM and high yield. And so it gives you a totality of exposure all in one ticker.
Are the younger investors, you think, gravitating towards ETFs? I have always thought that they would naturally do so. And when I talked to some institutional investors this last week, they pointed to, trading apps that don't maximize ETF usage. Is this part of, you think, the new frontier?
I do think there's a very broad trend that we think is helping to propel this market. As you know, we've been very vocal about where we think bond ETFs are going. We think we'll hit $2 trillion this year. We think we'll hit $5 trillion by the end of the decade. Part of what is propelling that is what we refer to as the modernization of the bond market. And we just touched on it a little bit, which is this idea that a recognition that these are very powerful tools to navigate fixed income, either taking risk or hedging it. We do think the next generation of investors are really grabbing onto that. And we're seeing that generation of portfolio managers really embrace these products.
I also wanted to get your thoughts on a trend that's really developed. It feels over the past year when it comes to fixed income ETFs, as that market gets bigger, you've seen certain products come to market, such as the U.S. Treasury 3-month bill ETF, ticker T-bill, which just tracks T-bills. Launched less than a year ago. It's over $1 billion in AUM. And also Bond Blocks has had a lot of success with sort of their specific maturity-focused ETF lineup as well when it comes to the fixed income universe. Do you see sort of investors having that demand for these more specific products? We talk about the TLTs, we talk about the AGs of the world, but what are you seeing when it comes to maybe more focused and carved out fixed income products?
We're seeing this in our suite as well. So our iBond suite, which is our defined maturity suite, is now sitting over 20 billion. We've taken in over 5 billion year to date, and half of that is actually in Treasury. So we're seeing this desire for precision and granularity in different ways. And that's a trend that I think is going to continue. I think for an entry investor, someone who's not familiar with bond ETFs, a defined maturity ETF is a great way to sort of get into the market and understand the exposure, because it looks more like a traditional bond where it rolls down and matures.
All right, Steve, thanks so much for joining us. Steve Laipply there of BlackRock talking to us about the bond market in ETFs. Coming up, Equal Weight is in style as investors send a record $1 billion into one fund that treats every stock the same. We'll discuss why next. This is ETF IQ on Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with T-bill. We were just talking about this fund. The ticker is T-bill. It only tracks 3-month Treasury bills. It launched less than a year ago, last August. It's already up to $1 billion in AUM. You saw that weird little spike in March, but now you can see it is definitively above that threshold, again, less than 1 year after launching. So we'll continue to keep an eye on that fund. But let's also talk about JEPI, because we talk about JEPI every single show, it feels like. We discussed last week that you saw some copycat-like filings from Goldman when it comes to JEPI, when it comes to JEPQ. Now we have another one to add to the list. You had the Rex FANG Equity Premium Income ETF get filed last week, that application landing with the SEC. So still very much an arms race going on. Let's also talk about equal weight ETFs. This really caught my eye on that. You have the Invesco S&P 500 Equal Weight ETF, ticker RSP. Took in $1.1 billion last week. That is a record weekly inflow. And this fund launched all the way back in 2003, so that's saying something. This, to me, says that the FOMO is back, that retail investors are bullish. Let's talk a little bit more about this issue with Bloomberg cross-asset reporter Isabel Lee. Isabel, thanks so much for joining us. Yeah, so I guess this means investors are betting on the rest of the market to catch up to the mega cap stocks that have driven this rally.
So I talked to an economist earlier, and he said the market is so bipolar. There are two. Bipolar means two. So the other side is FOMO. They're like, we want to get in on the rally. We don't want to miss it. NVIDIA is now trading 46 forward earnings. Microsoft is also trading 30 times. But the other half is, wait a minute. If this keeps on going up, it must come down soon. And so they're betting against the rest of the market. And so that's the other part. So I think that's the retail investors that's emerging right now.
So you have the RSP flows, maybe people, not wanting to miss out on the rally, but also maybe a little skeptical over valuations right now. What is Wall Street saying when it comes to the narrow breadth that we've been talking about?
So even Wall Street is kind of bipolar or bifurcated. We have Goldman Sachs saying that this rally might spill over to other sectors, so they're kind of betting on it. But Morgan Stanley saying, no, in the 1940s, the S&P rallied 24% before it hit a new low. So they're saying that this is temporary. Well, it is also Mike Wilson, who is a big Wall Street bear. But then even Wall Street, we love him. Even Wall Street is kind of mixed feelings towards this bad breath.
So, yes, bad breath. It's a pun that I may use today. In any case, why now? Why are we seeing this happen now? Is it just because of the bull market that we saw at the close on Thursday and Friday?
I think why now, because we've never seen a rally this narrow, especially in one sector. In fact, just really 5, 6, 7 firms. So that rally has really powered over the market. S&P entered bull market territory last week, and now it's kind of fading. Year to date, we're only up 12%, and so retail traders are really just banking on the downfall. And even with the flows into RSP, I mean, it's not like people are coming out of tech funds necessarily. Yes, that's a great point. So the thing with ETFs is we don't know who's buying them. So maybe this is getting flows, but SPY is probably also getting flows. So we could be betting on
I maintain this is a bullish bet, right? Because the idea is in the S&P, you've got these huge mega caps that have driven the rally. The rest of the market has to either catch up or the mega caps have to come down, right? And if it's the mega caps coming down that ends up being the case, no one's going to be happy that they bought RSP.
That could be the case, but then that's a market. It's always a risk. I might point out that I wrote the story with Katie. So that's why we're proud about this story.
We are, yeah. And it's interesting. Again, this is it's a very old fund, too. It goes back to 2003. It was one of the first smart beta ETFs to hit the market. So to see these kind of flows, there's a signal here. And we'll see which one pans out. But Isabel, really great to have you. Our thanks to Bloomberg's Isabel Lee. And still ahead, after the Canadian wildfires' impact on the U.S. East Coast, we're going to drill down into the Procure Natural Disaster Recovery ETF with Andrew Chanin. That's next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Matt Miller alongside Katie Greifeld.
Eric Balchunas from Bloomberg Intelligence back with us now for today's drill down, where we focus on one ETF. Eric, what do you got?
Katie, today we have a very timely ETF. This is the Procure Disaster Recovery Strategy ETF. The ticker is FIXT. And timely, last Wednesday I was here in New York City. It looked like Mars, okay, because of the wildfires. So this is a good one to do now because this looks at companies that are engaged in recovery from natural disasters, from wildfires, hurricanes, earthquakes, etc. This is a ETF that came out about a year ago. 75 basis points is the fee. It's thematic. It's very concentrated. Let's look at the breakdown of sectors. This is the important part here, I think. Theme ETFs typically, like this one, go across the world. So only 58% US. And then you look at the sectors, a lot of engineering, construction, retail, machinery. If you look in the GIC sectors, it's 66% industrials. So way overweight versus the market there. And you're going to get 40% small and mid caps. Okay, so you need to know that going in. Let's look at the performance of this versus the all world index, since it holds a lot of the world stocks. And I put SPY in there just for fun, and it's doing well. It's up 11%, nearly doubling the returns of both of those. And you know that's good. It's a good amount of return there, Katie, Matt. A little more of this, and this ETF I think could see some looks if this continues.
All right, Eric, thank you so much. And joining us to talk about this ETF is Andrew Chanin. He is the CEO of ProcureAM, the issuer behind this fund. Great to have you on set with us. Looking through the holdings, it's interesting. You've got about 51 holdings in here. I see NVIDIA as the second biggest. Can you walk us through that?
So this is an equal weight strategy. So names come right back in at rebalance and reconstitution periods. But this was a name that certainly has had very strong performance since the last rebalance. Something that NVIDIA does for natural disasters, it does modeling. So it utilizes AI. When you have a wildfire, it's actually remotely detecting structural damage and reporting that information back to those that need to know this. So it does do a lot for modeling and disasters.
I think this ETF is fascinating, and we love, obviously, for the media, these thematic ETFs play out really well, right? Is there still as much enthusiasm behind them as there was last year when they first got really hot?
Well, it's competitive, and
you run other thematic ETFs, we should point out.
Absolutely. I brought out my first thematic ETF as a sponsor back in 2012 and have done over a dozen across the US and in Europe as well. And thematic ETFs, when people realize what they're actually providing and they become timely, they can certainly garner interest, not just from the media. And being a part of the world's first cybersecurity ETF, the first mobile payments, even the first AI fund years ago under the theme of big data. You could see sometimes things take off immediately, like cybersecurity did when the Sony breach happened 2 weeks after the launch of that fund. Sometimes it takes several years, like it did with the junior silver strategy. Natural disasters are something that have been around forever, and they're going to be here to stay. The U.S. government predicts that by the end of this century, it will cost the federal budget, the U.S. federal budget alone, $2 trillion per year dealing with natural disasters. So some are actually seeing it as a growth industry as well.
And I will give you, Hack was one of the best time launches ever. 2 weeks before that, the thing blew up. I think it really set a good case study for thematic ETFs. Now, one that you launched that did not have the best timing, UFO. So you have the disaster recovery, you have a space ETF. There's been a bunch of space ETFs. UFO trailing the ITA, which is the defense and aerospace ETF. What's going on there? Like, I know space is supposed to be a big deal. What's the issue? Why aren't the returns there?
I think a large part was during the SPAC boom. A lot of smaller private space companies did end up going public, and a lot of them made it into the basket. It is a passive fund, so it looks for companies that derive a majority of their revenues from space. It also does have some of your more diversified aerospace and defense names in there, but they're capped. You can't have more than 20% of the index focus on these more diversified plays. So it's really looking at companies that are deriving revenues from space. A lot of the ones that have made it in because of the SPAC boom, a lot of them are actually falling out of the index now due to rebalances and fund rules. So we're looking at a fairly more pure play index, and it is off its lows, a decent amount from earlier.
With regard to FIXT, I mean, it is definitely a growth industry, right? We see more and more natural disasters costing insurers and governments more money around the world. Is it, have you been accused of being opportunistic? I mean, we're focused a lot here at Bloomberg on price gouging today, I mean, are people concerned that you're going to profit off of others' losses?
If people say that, that's not the intent. I lived in Louisiana during Hurricane Katrina. I was in New York City during Sandy. I was in North Jersey during the smoke from last week. And what you really need to understand is that these companies are the ones saving us when we need it. They're not the ones being accused necessarily of price gouging. They're the ones that are coming back and rebuilding. Before storms happen, they're the ones that are actually building out the infrastructure to better protect us. So these are actually incredibly important companies. We're happy that this fund actually champions these companies that help us in our darkest hours.
And FIXT is pretty small, less than $1 million in AUM. Who do you see as the audience for a fund like this? I mean, are you thinking that you're targeting institutions here or more the retail players?
I believe that this is really wide-ranging. This has been something that I've been thinking of since back in my days during Katrina. What are these companies that are really important and critical? And yes, this might be a growth industry in the future, but these companies are around and have been generating real revenues for years. But we think that maybe this could be something for an insurance company, a P&C company. This might be a way for them to possibly hedge some of their risk. This could be something for someone that lives in a high-risk area, a coastal area. You think of a Miami that's always potentially in the crosshairs of a hurricane. And this fund has many companies. Roughly a third of the companies in the fund actually do something specifically to help with fires and wildfires. So not that it's necessarily a pure play wildfire strategy, but there are many companies that are helping with all sorts of disasters.
You work at Procure. You work with Bob Toll, who is an ETF pioneer. He was at the firm that coined the acronym ETF. What do you guys have planned beyond these two ETFs?
We look to do a lot more in the thematic space. We'd love to see more support in our current funds, though, as well. We know nothing is an overnight success. Typically in the ETF world these days, and we really want to get on more platforms, make our funds more available for the investors that want to get access to it. But we're always working on new thematic plays that we're really excited about, and look forward to getting there.
Andrew, before we let you go, listening to you describe FIXT, do you consider this an ESG fund?
I'm so happy you brought that up. This is completely contrary to most environmentally focused funds. Most are looking for low carbon, net zero, low emissions, renewable energies. And this fund is something completely different. You're getting different exposures. It's all great to invest in, say, the next company that's a great bank that's doing really well as a bank, but they're also trying to reduce their footprint. But when my house is under 10 feet of water, I'm not going to care that the bank that I use has a low carbon footprint. I'm going to need these companies, and this is providing completely different exposure for investors, and hopefully it could be an interesting part of many people's portfolios.
All right, Andrew, fascinating products. I'm really glad you could join us on this program. Andrew Chanin there, CEO of ProcureAM. And a quick programming note, because of the Juneteenth holiday, we will be here on Wednesday, June 21st, which I think we all agree is a much better day for this program anyway.
I'll take what I can get. Some days it's Wednesday, some days it's Monday.
I love Wednesdays. Yeah. I'm in a groove by Wednesday. Monday, I'm just still coming to.
Yes.
A little bit, yeah.
Yes. Although you guys both seemed really alive today, so thanks very much. If you just can't get enough of ETFs, reminder, you can listen to Eric and Joel